Hey traders, how you going? Alright, so this video is going to kickstart the series on Forex trading, and I'm going to try and keep it as simple as I possibly can. This was a special request by one of the subscribers, and it's to do with trading Forex on higher time frames. Now, for those of you that are seasoned Forex traders or have been doing it just for a short period of time, you probably have discovered by now that the 4 hour chart possibly is the best time frame to be trading Forex off. The reason for that is, I believe, patterns, especially harmonics, pretty much it paints more accurately off the 4 hourly chart. The overall, if you could say, the seasonal targets in Forex are broken up, I think, monthly, weekly, and that shows up more accurately on the 4 hourly chart. There are significant components to trading Forex on the 4 hourly chart, or any chart for that matter. But what I'd like for you to look for on a 4 hourly chart, and that would be one, candlestick patterns. Um, we're looking at also structure and patterns. So remember when we discussed in one of my recent videos, understanding the market cycle? It's on the channel if you haven't seen it. What that would do is it will give you an idea of the direction the market and the waves the market moves in. And in doing so, it creates specific patterns or structures, right? So we're actually looking for all of those before we actually then look for a setup or a possible entry, right? Before I go into that, the other thing that I want to quickly discuss is the use of brokers. Now, you've got a number of questions have come in regards to whether you use ECN brokers, whether you use market maker brokers. Be aware that with the dealers, the market makers in particular, they do use ECN brokers as well. It's not to say that they don't. There's large volumes going in through ECN and their own stuff. Um, there are marked differences between the two. The ECN brokers is pretty much like a pool, an exchange. So the broker that you're dealing with, they'll make money off you via commissions, and then the other end of that contract that the trade that you're taking, the other end of that contract is taken up by a pool of other traders out there, right? So the broker itself pretty much is running like an exchange. Whereas with the market dealer brokers, these guys pretty much are the ones that are taking on the other end of the contract. Now, be aware that the market makers, the reason why they have the ability to move the market significantly or control the market significantly is just because of the sheer volume in net dollar amount that they actually have to trade with, right? So, these candlesticks that you're seeing painting on your screen, it takes a crap load of money in order to move that just one pip. So when you're seeing spikes, when you're seeing massive candlesticks like this, there's a crap load of money behind that. Okay, so understand that, and that's why we say, retail traders, we pretty much don't have much of an impact on the market itself, besides the fact that the money that we put into it is the motivating factor for the dealers anyway, the larger, the market makers, the market dealers, right? So if you can understand that, fantastic. What you're also looking at on your charts pretty much is the footprint that's been created by where the market's already been, right? I always see comments from traders in under YouTube videos where they say, a lot of teachers out there, they pretty much go ahead and they're looking at what's already painted, and they're saying, well, why are so many of the gurus talking about so much of what's already painted? The reason for that is that what's already painted is what's going to give us a very clear indication on where the market is about to go. And when the market responds in real time, so in order for me to know what's going to happen beyond here, I really need to go and study all of this. So it's almost like, if there's footprints heading in a particular direction on the sand, I know that whoever is, who's created the footprint is going in that direction. I wouldn't go searching for the person here or their footprints here if the footprints are heading this way, right? In the same way, when you understand how the market moves, whether it's just the market patterns, whether it's harmonics if you utilize them, whether it's support and resistance lines, whether it's a very clear understanding of how the market makers work, stop hunts, or even an understanding of how the EMAs are formed and how they're calculated. All of that combined is what's going to give you somewhat of an indication as to where the market's going. The whole purpose behind Forex trading for us is to be able to jump right on the back of the big movers. So if, say, for instance, the market wants to go in this direction, in Forex terms, all we're doing is jumping right on their back. So guess what? We go along with them on the right, and that's all we've got to do in order to make money, right? The absolute secret to trading Forex, in my opinion, has nothing to do with indicators, has nothing to do with technicals, has absolutely nothing to do with fundamentals. It has everything to do with patience. That's it. If you want to separate those traders that are making a ton of money, you know, the 2% or the 5% right at the top, and I don't really know how they come up with these calculations, right? But say, for instance, we took that into account. If you want to be part of that group, what you've got to have is patience. That's it. Some of the most skilled traders out there, they don't day trade. You know, there are day traders out here that are doing well and making great money, but they also have a ton of losses. You know, when people are talking about ratios, 1 to 1, 1 to 2, whatever it is, those are day traders. When we're talking about longer term traders, really successful traders out there, they will wait for their exclusive setup. If it means waiting for a month, fantastic, they'll wait a month because they know when that setup happens and that market moves in the direction in which they've analyzed, then even if it's for like 50 pips, 100 pips, or whatever it is, and we're going to run through some examples here shortly. But if it's for, say, 50 pips, if they are so sure of their setup, they're happy to put 50 lots, 100 lots, 500 lots. There are some brokers out there that will let you trade up to 1,000 lots. These traders are happy to put that much money down, or that many lots down on just one trade. And if it takes 3 months for that to set up, fantastic. Go do that over 3 months. Whereas if you sit here and you're saying, okay, I'm going to do this just daily, every single day, I want to make and I want to have consistency, that becomes a little bit more difficult for a lot of people because you know your emotions, your whole uh, physiology, all of that kind of changes on a daily basis. You know, there are days when I am tired for no good reason whatsoever. I wouldn't go out and trade because I know I will mess up my analysis if I did, right? Now, so coming back to the point, here are a number of things. I've put together a bit of a criteria. Now, for the time being, disregard this. The EMA 6 and EMA 5 cross is one of the more popular known strategies for Forex out there. I don't like it very much because sometimes there are just too many of these crosses and they're harder to analyze. But it is, if you Google like a EMA cross or MA cross strategy for Forex, this one probably will be one of the most popular ones, and it's quite an old one. A lot of people are making money off of that. Personally, with the crosses, as some of you have probably already guessed, I prefer the EMA 50 and the EMA 200. It will take time for these to set up, but when they do, they're fantastic, and you can actually go for a run. There've been days in the past, and as I used to say in my previous videos, that when I held a day job, the specific Forex trades I used to do used to be off a 4-hourly chart, right? So this is what I used to do. It used to just be a cross of the 50 and the 200. The 50 is the faster moving one, the 200 is the slower moving one. If at any point in time you see the slower moving one cross up above the slower moving one, so the faster moving one, sorry, crossing above the slower moving one, then we're assuming that the market is going to continue on an uptrend. If at any point in time the faster moving one crosses below the slower moving one, then we're assuming that the market is going to head in a downtrend, right? That's just one aspect of the criteria. It doesn't mean that's what you're going to do blindly, because here's a clear example where the EMA 50 did cross up above the EMA 200. Now, if you took a trade at any point in time here, you probably at this point here would end up with 77 pips in the money. But if you're trading for a longer term, and that would have been a 4-hour trade, but if you're trading for the longer term, you probably would have ended up losing money because this market since that point has fallen all the way down 310 pips, right? So that's just one aspect to the overall criteria. So if we go back here, what you need to make sure of is one, the market cycle. What do I mean by market cycle? Remember Elliott waves, market moves in waves, and we did something along these lines of say, let's say the market, that's an X up here, that's an A, A, B, C, D pattern for those of you that are familiar with that as well. But here's where we're thinking that the market moves in waves. We've got, say, 1, 2, 3, 4, and then this market may come up here and do a 5. This may go, and for us, here's the critical thing. If the Elliott waves here is correct and the market moves back up somewhere along this line here, then a number of things are going to happen. One is that it will then create critical structure for us, something that we recognize. And in this case, that most likely might be a double top. When does the market come up and do something like that? God knows. Right now, what we do is this. We grab our horizontal line. We're looking to see if there are any key resistance areas up here, right? And you could say, okay, the absolute biggest one, I'm going to do an average here. Let's grab our horizontal lines again, and we'll do an average somewhere around here. So we capture this point, there's wicks here, that wick, there's a wick there, this point, and somewhere close to this point, right? Notice how we were looking only towards the left, but notice how this point here hits that line, and then there's a slow decline from there, right? So what we're thinking is that the market's going to push back up somewhere, back up here, possibly. Now, what we're waiting for is the market to set up exactly as we would want it to set up. So it doesn't really matter in my case. I mean, this is how I'm doing it. Some other traders do it differently. It wouldn't really matter to me where this market will come up and hit that line. I'm going to use Fibonacci to try and predict it, but I wouldn't really rely upon it. What I'm looking for would be, and which would be now the second part of my criteria, would be where the market issues a wick to the high somewhere here, right? So there's a nice fake up to the top, which pretty much confirms to me that the market or the market makers there, they are now clear. So and when I'm talking about the wicks, I'm talking about something like this. A wick to the high bounces back down and finishes. So if you have a clear look at this wick itself on this red candle is 100 pips long. That to me says it's a confirmation from the market maker that, yep, we've done our business up around here and we're getting ready to enter now a channel going this way. And what I mean by channel, something along these lines. See this? From this point to this point. Now, again, we're thinking along the lines of being a longer term trader. Now, have a good look at that. That channel from the bottom of that candle to the top of this is about 970 pips, right? Duration wise, this is at the earliest 16th of August, and the top of this is the 1st of September. So that's about a 15-day trade, and in 15 days you would have banked about 970 or so pips, right? If you want to trade longer term, this is how we do it. Now, what I'm waiting for here is a number of things. One, I'm looking for a clear indication from the market that it's going to climb up and then a spike to the top, and then it starts heading back down again. All of our entries would actually be a 2-bar setup. And what I mean by 2-bar is something like this. For example, let me go back a little bit so I can show you something that's already happened. Okay, something along these lines. So we've got a green, in this case, a green candle going up, and then we've got a red candle wick to the high, pushing down, and then finishing off in a red candle. So we've got green candle, red candle, right? So it's got to be 2 bars. So on a 4-hour chart, your setup has to be over 8 hours. But the setup of, say, a double top to happen here Look at this. This is for the market to bounce off the EMA 50, go up here. That's 1, 2, 3, 4, 5. That's 20 hours right there. 6. That's a full day. And then come back down. 1, 2, 3, 4, 5, 6. We've got 2 days roughly. So just two and a bit days for the market to set this up for us. Now, if you were to just go on a 4-hour entry trade back down to the EMA 50, where are we? So from here to here, that's 95 pips over 4 hours. But what we're looking for is a trade that's going to be much longer. And this is why I'm saying I'm waiting for now this to enter to start falling after the double top, to start falling, and in doing so, establish a channel for me, right? So let's have a look at the criteria again. Market cycle, understanding where the market's headed. So it's done its the double bottoms, and then it's gone up. It's pulled back at least twice to a significant point, and then gone up to create another structure for us, which in this case would be a double top, right? Structure wise, how do we determine if the market has or is doing what we want it to do in terms of structure? Well, we do this. Okay, we grab our fibs. Let me get rid of these lines. Okay, so we grab our fibs here. Now what I'm going to do is I'm going to run my fibs on this according to this high and this low here, right? Okay, so I'm going to establish that as the official high. And I'm going to establish this now as the official low. What I'm waiting for now is to, not waiting for, sorry, what I'm looking for now is where there's a clear run, bounces off these points. So the most significant one for us would be the bounce off the EMA, the 61.8 line. Once that bounces off, and keep in mind, for those of you that do want to trade these, you can trade these reversals as well for short periods. Okay, just don't let it run for too long, and you can do it maybe a few candles. You can do it over a day or so. You could probably wait to see if it bounces off one of these lower lines. In this case, say for instance, we took this red off this red confirmation here. You could have taken entry on this candle. The issue with this is that first of all, off this 4-hour chart, you could have a 4-hour candle, you could have pulled out about 37 pips, but the next 4 hours pulled back up again, and you would have been pretty much, actually, you would have been out of the money given spreads for that next 4 hours. And then the following red candle pushed the market back down again. You probably would have been about 30, 40 pips in the money again. You would never know that. But what you could do is, if you wanted to carry forth with a longer term trade, and you said you do believe that this bounce is going to happen and the market's going to pull back down to at least this fib line here, then you could do that. And that's a 92 pip trade over the course of, for a 12, 16, 20, 24, we're looking at roughly about 28 hours, right? If you like trading that way, that's fine. You can do so. In this case, what I'd say you do is you could look for entries off here, because you would have counted your drawdown from this high here. Now we're looking at this and we're saying, okay, all the way to 61.8, pull back down here. So if we were to say apply the ABC pattern to this, and again, remember harmonics, your Gartleys, your butterfly patterns, your ABCD patterns, and then you start applying head and shoulders to this. You apply your double bottoms, your double tops, all of that to this, and that will start helping you to kind of formulate a picture of where you think the market's about to go and where it's going to go from that point on. So in this case, we're saying, I'll draw this as an X on an ABCD pattern. This would be my A, this would be B, we'll call this a C, that's the lowest point after the B, and then the market bounces back up from C to D somewhere up here, right? Usually on a higher time frame, what I do is I draw my fibs in, and I've also added with my fibs here another line, which is the 78.6 line. Okay, so you would have the 61.8 and the 100, and this would be a gap for you guys. But what I usually do off the longer term trades is I'll add another line to my fibs. And how you can do that, see this red line, double click on that, go into fib properties, and where it says Fibo levels, right, you can click add. And what I've done here is you'll get another line down here, and you click on that, and I've just added 0.786 and the description, which will show up here as 78.6, and just click OK, and that will show up. That will add up to your future fibs as well. So I've added on that on. Now what I do is I'm waiting for the market to come back, do its thing, and then climb up somewhere to the 78.6 line or slightly above it, and then I will start to look for entries on, and the entries, the setup may happen over 12 hours, may happen over 20 hours. It depends. Notice how here's what I would do. Go back. Here's what I would do is where I'm looking for candles and wicks here to start forming lower highs. So this is a lower high, this is a lower high, this is a lower high. And this is what I love doing in this case as well, is once the market comes down, I don't trade it here, I don't trade it here. I wait for the push back up again. Once the market pushes back up again, you could possibly take an entry off these lines here, these yellow lines, the Fibonacci lines. You could take an entry up here. Now, be mindful of the fact that this would be a long green candle, right? But you could take an entry off here going this way, right? You could jump onto the hourly chart after that. You can jump onto the 15-minute chart after that and seek out confluence. And I'll show you an example of that shortly as well. There's something happening on the pound USD currency pair right now. So I'm waiting for it. Okay, so you would do that, right? And combined all of this so far, where you're seeing this establishment, the fibs are lining up, your patterns are lining up, you understand the market cycle here. The next stuff that we're looking for now, entry-wise, is EMA 50 and EMA 200 cross, right? So in this case, let's have a closer look. Now notice how here the EMA 50 is starting to cross below the EMA 200. Okay, it hasn't fully done it yet, but it is starting to cross below. This hit on the EMA 200 is one of those identifiers for me that there's a potential that this could bounce off just off this point here. There could be a spike to the high, and then the market will start coming back down again. There's a potential of that. So what I'm waiting for is this EMA 200 to cross below. I want a spike to happen at some point, and then the market to come back down. And what I would be looking for is that where the market comes down and then goes back up and then hits my EMA 50, so like pretty much a bounce off the EMA 50 like it's happening here. So in this case, it'd be like where there's a green candle that hits it, bit of a wick, and then the next 4-hour candle creates a red candle that comes down. So something along these lines, where the red candle comes down here, hits the EMA 50, and then bounces off of this and goes up again. That is a clear bounce off the EMA 50, right? How I would trade it is something along these lines here. How I did trade it was something along the lines of what's happening here. Disregard the analytics, but what normally I would do is wait for this movement to push back up, and then I'll take an entry off the next candle, right? And off the next candle, I'd keep trading this, even if it's coming back to this point. I'll keep trading as long as it doesn't fall below this line here, which would be my entry line. And you can draw that in. Say for instance, I did enter here. That would be my entry line. If it doesn't fall below that, I'm still good in my trade. So what would happen is I will continue trading this until price actually comes back and hits my EMA 50 again. All right, that's the simplest way to actually trade Forex, where we're literally taking two EMAs and we're analyzing market structure, we're analyzing the market cycle, so we understand the directional flow of the market, whether it's going to continue going up or it's going to now hit a high for the month, week, season, whatever, and then start coming back down again. And we understand if this is the official high and it's starting to come down, then what we're now looking for is a cross of the EMA 200s, and beyond the cross of the EMA 200s, I'm looking for the EMA 200 and EMA 50, so the two EMAs, and then after that, I'm looking for stop hunt. I'm looking for a hit back to my EMA 50, so a literal bounce of the EMA 50. I'm looking for candlestick patterns in particular, so something along the lines of this would be great. I absolutely love like this sort of stuff. The morning star or evening star patterns, they work really well for me in that regard. So if say for instance this was an EMA 50 running this way, and this is a red candle hitting down on my EMA 50. I've got a bit of a tiny candle here, green preferably. If it's red, a small red one, doesn't really matter. And then a nice green candle here pushes back up and gives me somewhat of an like a morning star pattern here. Fantastic. I would look for an entry off the next candle. Okay, and how it would have been is where I'll take that entry, and my analysis would tell me that this is going to continue on. The EMA 50 would just continue on for a while here, so I would take that trade and wait for price to come back and hit my EMA 50 again somewhere up here, and in however long it takes, that is a 105 pip move, right? Okay, so you guys with me so far? Please write some of this stuff down. So again, market cycle. Let me change this actually. And mind you, so if we keep this at EMA 200, set that to open, and if this is our EMA 50, set it to close. Okay. Criteria wise, so understand market cycle, understand the pattern. The patterns are your M's, your W's, which is your double tops, your double bottoms, your butterfly patterns, your Gartleys, all of that sort of stuff. I am meaning to put those individual videos together to show you what they are, but there are a ton of those sorts of videos on YouTube as well. So if you guys just type in Forex patterns, and a lot of these videos will show up. Study them, and hopefully by the time I put those videos up, you guys will have a better idea of what they are, right? The EMA 50 and 200 cross. Go onto your charts, jump onto a 4-hour chart, and look at every time the two have crossed. It's not going to happen all the time, and like I said earlier, you probably won't have to wait too much anyway, because you'd be trading a whole heap of currency pairs. But at the same time, keep in mind that when you find those setups and you trade them, you might be trading them for 4 or 5 days, and in those 4 or 5 days, the potential of making 400 or 500 pips is there. You know, once you get a hang of this, you'd be trading them, and you would eventually be trading them at higher lot. So you will have the ability to wait for those setups to happen, right? Okay. Okay, you enter on the next candle. Right, now, so let's jump on to pound USD. This is what's happening right now. So this is what I was talking about earlier. Now, here, a couple of things is going on. One is that here the EMA 50 has just crossed above the EMA 200. So I'm not taking a trade straight off somewhere here. I don't want to do that. What I'm waiting for is price to come back down and hit my EMA 50. Look at this. Hit down, little doji red candle, and then we've got a nice green candle going up. So remember what I said earlier, my candlestick pattern, which in this case is a morning star. So we take this into account, that's point 1. We take this into account, that's point 2. We also now analyze to see where this is in terms of our run. So we'll say, okay, this is, say for instance, the previous high. We'll count this as our absolute bottom that we're trading. I'm going to grab my fibs, draw from here to here for the time being. I can actually extend that out to this point as well. So I could draw a line up the top here. And I'll just extend that to this point here. Okay. And the reason why I'm doing it at this point, that's the highest point that I can see, and I want to analyze based on this movement from here to here to see what price has actually done so far, and those bounces will give me a clear indication of whether or not what I'm about to predict is going to be accurate or not. So remember what I said earlier, you're looking at hits to the high here. So in this case, I'd say this is the first wave, down, second wave, down, and this is the third wave, right? So we'd say 1, 2, 3, 4, no, sorry, 1, 2, 3, 4, 5, right? And that's how we apply, forgetting here, Elliott waves, okay? Now what I'm expecting is the potentiality of, say, here, you could look at this and you can start saying, okay, this market most likely may push back down again. Here is a pattern that to me, at the present moment, is looking like it's a head and shoulders pattern. So we could have actually taken a trade possibly off here. So this point here, and let me zoom in so you can have a clearer look. See here where the price did come up slightly, you could have waited for this hit to the high here. Taking an entry here, move. So taking an entry here would be roughly about 40 pips or so for over a 4-hour period. This is part of the reason why I kind of do like trading the 15-minute charts now when I have time, because I can hit those 40 pips in maybe half an hour as opposed to wait for 4 hours for it. But that's a 4-hour trade, 40 pips in the bag. Now, if you kind of knew that this is a head and shoulders pattern, market's coming down, that sort of stuff, you'd be like, okay, you know what? I have a feeling that this is going to run for at least my 50 pips that I want to collect, or 30 pips, or whatever it is, and then you can put a crap load of lots on top of that, collect your money, and walk away. But in this case, what we're waiting for is, if I'm thinking that this is going to be a hit to the high again, it's not going to break this point. If it doesn't, if it offers me a wick to the high, which would be a stop hunt. So the next part of the criteria here, which I didn't write, is stop hunt capital. So if I see a stop hunt, that's a further confirmation for me that this market is starting to head down. When you're trading a 4-hour chart, you don't have to jump in at the highest point or at the lowest point, okay? In fact, I prefer not to. The reason for that is that I want the market to show me a clear indication that it's done its business up the top and it wants to head back down again, right? So like I said here, you could have taken your entry, but for the time being right now, you'd be sitting here 4 hours, 8 hours, going on to pretty much 12 hours, somewhere between 8 hours and 12 hours in your trade. And so far, you would have only made 46 pips, and then the market would have bounced back to you being roughly now about 12 pips in the money, minus the spreads. So that's like a 9-hour trade so far, and you're only literally sitting on 12 pips, right? That kind of doesn't work for me, right? So what you do is you wait for the market to finish up its business here, do its head and shoulders thing, do everything that it needs to up here, spike to the top, and then come back down and do something like what it's doing here. Like, it's crossing down below the EMA 200. We're waiting for a spike. We're waiting for a nice red candle to the low to confirm to us that this is doing its thing. It's moving. And when it does, what I do know is that once that red candle has made its move, the next one or the next few candles will actually come back down to a point below this line here, below this point here. So if it's doing that, and the reason why it's doing it is because this is going to establish now a downtrend, right? So like this is an uptrend, this is going to establish a downtrend, and in that longer term downtrend, what we're looking for is lower lows. So if the market comes back down here and it bounces off somewhere here and doesn't break this low, then what we're saying is this market's still continuing on an uptrend, and this is just a short-term pullback. So if my analysis is correct, and once this comes back down again, What we're looking for is for price to come and break this lower low and establish a new lower low. If you look at where my line is, if it just comes down slightly below that point, we're still about 110 pips to go there, right? So that's when I would look for an entry again, and hopefully that's when, like, market bounces back, spikes up, hits my EMA 50, and then we go for a nice long trade south. Okay, have I nicely confused all of you? Okay, I'm looking for a trade. I did see one yesterday. Where did I see this? Okay, hold on a second. This was off a. Sorry. This was off a run here somewhere. Okay, here we go. Here's a clear example of what's gonna go, what's happening. Right. So I'm gonna zoom out. This is the perfect trade. This is the perfect setup that we're looking for. Okay. So this is on pound NZD. First thing that I'm looking at is that where did the market actually change from being an uptrend to a downtrend overall? This was the uptrend. Notice how the EMA 50 is above the EMA 200, and notice how it actually comes back in waves somewhere close to, so here it goes up, and you'll see it come back, hit the EMA 50, goes out again, comes back and hits the EMA 50, and also notice how the EMA 50 is away from the EMA 200. Some people actually just look for entries when they understand that whether this is an uptrend or a downtrend. When they understand that over a longer term, what they'll do is they'll look for entries just at the cross of the EMA 50 and EMA 200, and they will then cancel out that trade when the 50 comes back and crosses the 200 again. So in this case, if you could really wait from this point, which was April 2015 till September, or end of September, October 2015, that would have been one long trade. You could have waited for price. If you waited for price to come back and hit the EMA 200, there we go. That's 3,700 pips. And here, if you waited for the EMA 50 to come back and cross the EMA 200, that's 4,283 pips. How many months? We're talking, was it April, May, June, July, August, September, 5 or 6 months. Come September end, so 5 or 6 months. That's not bad. But here's what we're doing for the time being. We're waiting for this to cross, and then we're looking at the behavior of price. So once price comes back, hits somewhere near the EMA 200, and then bounces off, we're on a downtrend now, right? And if the EMA 50 is comfortably below the EMA 200 line majority of the time, we're on a downtrend. So here's what we're looking for, and this is particularly what I look for. I wait for price to come and hit above the EMA 200. I want EMA 50 to cross above the EMA 200 as well, and do something along these lines. I wait for, notice how it's above, we're getting higher highs established, and then the market does pull back down and start giving us a higher low. See this? A lot of traders would have looked at that and said, hey, you know what, I missed that trade. Fantastic. We don't wait for that. Here we are. What we're waiting for, and let's zoom in. This is the bit where I said the EMA 50 is above the EMA 200 line. Okay. So what we're waiting for is this EMA 50 to come back and cross it below the EMA 200 line and take a nice dive. Why? When the EMA 50 is very closely hugging the EMA 200 or slightly above or very close to it, we know that although the price is moving, it's not significant moves. I know that when this crosses, and there's a number of events that have to come together for this beautiful move to happen, all right? And I'll show you why there's benefit in this. Okay, so what I'm waiting for, first of all, is that cross. I have already done my analysis to know that the relationship between the EMA 50 and the EMA 200 show me that this is now a downtrend. I've gone back in my charts to look to see where the uptrend ended and then transformed into a downtrend. I am now looking for that moment where the 50 is above the 200 but slightly, and I'm looking for those the double top, triple top, quadruple top formations to happen. I'm waiting for the market to now start falling, and when it does, I want the EMA 50 to cross below the 200 again, and then after that, here's what I'm doing. Okay, let me blow this up a little bit more so you guys can see. Okay, now remember when I said the EMA 50 was above the 200, these are the patterns that it's making. We're looking for these wicks to the high. The wicks to the high are the stop hunts that we're looking for. All right, now when this happened, price closes below the EMA 200, does a nice little curve and comes back and hits it. Remember two candlestick patterns that we're looking for, this sort of stuff where it bounces off the EMA 200 and we've now got a nice red candle to the low. You could take your entries off here as well. And if you did on a 4-hour chart, wait, see this yellow line, that's my EMA 6 line. Whenever I take my entries, this is my own personal addition to my criteria, is I like if the candle opens and goes green, I want it to come and hit slightly either on my EMA 6 line or above it. It's just a personal preference. And the reason for that is where I tend to like where that wick pretty much consumes my spread. And if it's a nice long wick, what that does is not only consume my spread, but it will also give me a nice profit by the time the body starts to form again, right? So say for instance, I took my entry there in for a 12 hours, which would be down here. We're about 129 pips in the money, right? But I wouldn't be taking my trade there. Where I would be taking my trade is when market comes back down, does another wave. Remember, market is always moving in waves. Comes back down, does another wave, goes up, comes to this point. See how this long green, this would have been a long green candle at some point, came and hit somewhere very close to my EMA 50 line. This is part of my criteria where I like price to come back and then say hello to the EMA 50 line. And when it does, is when I'm starting to look for my entries. I wouldn't take it straight off there because you don't know if the market's going to continue going up again for a little while. We don't know. So what we do is we wait for this to finish off, hit. I want to see a wick to the high. Remember stop hunts? This is my stop hunt. Another part of my criteria is met. Price comes back down, this still finishes off in the green. Now, I don't take an entry straight off the second candle. Why? I'm waiting for confirmation that this market's ready to go this way. Okay? So we're waiting for at least 8 hours now. After this candle's formed, 8 hours later, this market shows me a nice, strong red candle going south, and I now know that this market's moving. We've got a very comfortable distance from where price is here, between here and the EMA 50. By this time, we now have a nice cross of the EMA 50 and the EMA 200. So what I'm doing now is, at the open of the next candle, and again, what I love to do, as I said previously, if there's going to be a wick, and sometimes there is, then what I do is I'd wait for price to pull up above my yellow EMA 6 line, and then I'll take an entry. And in this case, we're shorting the market, and you put in how many micro lots, mini lots, standard lots you like. Now, by the end of that 4-hour candle, I'm sitting at about 40 pips in the money, right? Here's where patience comes in, because at some point in time, depending on where I would have gotten in, this would have still been a nice green candle, and I would have been comfortably out of the money, right? This is where you've got to be very patient. Your analysis has to be spot on, where you know that this market is now still going to head south. So what I'm doing is I take my entry and then I sit there quietly. Okay, in 8 hours, I am 134 pips in the money, right? Now, understand that when the market is moving, you're going to get a number of candles like this one and like this one that's going to spike up to the high, because that's the market makers, they're doing continual stop hunts. And the purpose behind that is to catch those people that have very tight stop losses. Okay, in regards to stop loss, what I would do is after this movement here, I'd probably look for an initial stop loss just above this point. Okay, I'm pretty much certain that the market's not going to come anywhere up here, because if you look closely, that wick from top to bottom there is 200 pips, right? Initially, and you say, Shiva, you're going to put a stop loss for 200 pips? That's crazy. Yeah, it is. Initially, I'm putting that up there just in case, right? But my ideal stop loss would be somewhere up here, just above this candle. And you can probably add 10, 15 pips to that if you like, right? In my style of trading, guys, I don't want to take any major risks, right? So that's why I limit my losses quite significantly. And in doing so, it's my stop losses are just there just in case, a world leader gets their head blown off or something and the market goes nuts and just spikes the hell out. So in those instances, my full account doesn't get wiped out. But when I'm taking my entries are taken in line with a very, very solid criteria whereby I know this is going to head down. I'm going to be in the money in this, and it's just a matter of time. Something one of my close mates said, David, you know who you are. Dave said when he was trading, there was this feeling that he had, and he pretty much just said, when you take this trade and you know it's going to win, it's just a matter of space and time. I thought that was brilliant. That's how I kind of feel when I'm taking my entries. So I would have stop losses somewhere here, but I kind of want to make sure that they're just there against a massive fail that's going to happen. So that's my fail safe. But the overall analysis should be so solid that I kind of know I'm not going to need it, right? So at some point here, the market's going to be here. If you wanted to take your 130 something pips and run, fantastic. But the strategy that I'm presently speaking about, this is how it functions. You've got your entries on there, and you keep going on that trade until the market bounces back and hits that EMA 50 again. So the price comes and hits that EMA 50 again, right? When it does, we would have been 596 pips in the money. Your trade duration would have been, okay, so that's the 7th of June, and this candle here that comes and hits it is the 17th of June. So it's a 10-day trade. That is the simplest longer term strategy that you can apply to Forex, right? There are, as I've said previously, I had EMA 8 and EMA 5 there. The traders that use that strategy do exactly the same thing. It's the EMA 5 is a faster EMA 8 is the slower one. They will do their analysis around market cycle patterns, candlestick patterns. They know the directional flow of the market, and then what they're doing is they're just waiting for a cross between say for instance, this is the EMA 8 and that's the EMA 5. The market crosses. They take an entry pretty much on the cross, which I think is risky. I'd like to see a stop hunt somewhere. Take an entry off the cross, and then they'll keep running that. Or they'll keep that trade open until the 5 and the 8 cross again. Okay, that will give you shorter term trades. And let's do this, for example. Let me add that and show you what it would look like, and also tell you why I don't like it. So yep, we'll do that to close, I think. Yep, I'll leave that at close. Okay, so that's the EMA 5, and we'll add another one. Change the color of this to, what do I have up there? Okay, I'll just make it blue so it stands out for the time being. We'll make that 8, and we'll put that to open. Okay, so what they would do in this case is pretty much something similar. I would leave my EMA 50 and 200 there, so you kind of have a directional movement there. They will possibly, see, I would wait for a move like this, because you kind of want your confirmations, all right? Okay, let's take this example here, or even this example here. This is not a clear cross, but that candle, this EMAs did come very close. This big red candle forces the market to push back down again, and they'll take the entry on the next candle, and they'll keep trading that until the market crosses again here. So that would be 4, 8, 12, 16, 20, 24, 28, 32, 36, 40, 44, 48, pretty much 52 hours later, right? So roughly about 2 days, and when the market crosses again, and that would be 357 pips in the money. Exactly same principles. Because it's so close, I kind of don't like it so much, but you can play around with it. Play around with it if you want. You can make this EMA 8 bigger, maybe utilize an EMA 6 as the slower moving EMA, and have maybe a 14 as this one here, and just kind of trade the crosses. What you're looking for, guys, if I can run through criteria again, understand market cycle, understand the market, the trend direction, understand that the positions where you want to take the trade is at the top of these waves or the bottom of these waves, right? You don't want to take it anywhere in between. Take it at the top or the bottom. Look for the EMAs to cross. The best ones for me over the longer term would be the EMA 50 and the 200. But you can again utilize the 6 and the 14, or if you want to do what everyone else is doing, you utilize the 8 and the 5, and trade them in clear trends. Make sure you are looking for structure patterns. You can start adding harmonics to this as well. Look for stop hunts. So at the top of the waves or the bottom of the waves, you're looking for these nice long wicks. That's to show you. That's a sign from the market maker to pretty much let you know we've done our business there. We're going to head in the opposite direction for a while. If you see these nice big stop hunts, fantastic, go for them, right? Off the higher time frames. What else was there? Remain patient as much as possible. The other thing you can do is if you see market setting up like this, you can always jump onto a lower time frame and see if you can select a better entry. Remember when I said pound USD was setting something up like this bounce here? So if I would have taken my trade, the start of that, so far, I'd have been about 10 pips in the money, yay. So here's what I would do off that, is I'd jump onto a hourly chart. Okay, so this is finished. I'd jump quickly onto an hourly chart to see what the market is doing. Okay, so in this case, we know that off the hourly chart, the market's on a downtrend, right? Yet off this, we're kind of seeing that this market's pushing back up again. Remember I said we're looking for now, this is possibly a head and shoulders pattern. We're looking for a push down again. So I'm looking for signs of an hourly chart to say, okay, this market's ready to push down again. Same rules apply. Here's my EMA 50. Maybe this is going to be a stop hunt high somewhere at some point throughout. You know, we're in the mid Asian session. It's 1:15 in Sydney right now. So at some point, maybe in London, market's going to come down here, go back up, spike to the high. We're looking for that wave. See this point here. Market goes up, hits a high, and then a nice long candle coming back down in the opposite direction. Remember I said you're looking for a hit to the high again. See this candle opens up. My EMA 6 would have been hit here. I would have taken my entry. I might have been out of the money for a brief period for about 10 pips. And then at the end of that hour, I finish off 17 pips in the money. Next candle comes down. At some point during the New York session, price came down towards the EMA 200, and I could have exited that at about 66 pips in the money. Now, you're looking for entries around your EMAs, the slower moving ones, and you want to have your exits, you take profits literally, wherever. If you've got a certain amount of pips you want to collect, do that. I'd say look for hits to, say, the EMA 200 If price comes back down and hits the EMA 200, fantastic. You can take profit that way. If you are doing it off the 4-hour chart, you can pretty much, and if you're able to catch these moves, this is the official low, that's the official high. If you're able to catch the market here somewhere, and you're still at the official low, somewhere close by, you could ride this damn thing all the way up to there. And where would that up there be? I'd say you could ride it from this point here till about your 78.6 line. Okay, and if you did that, that is 353 pips. How many days? Let's see. From, where are we? Okay, from the 17th of August till, where did we get to? Here is the 2nd of September. All right, what's that? 15 days? 17 days. Something along those lines. So you could do that. That's your longer term trades. Okay, is there anything that I've missed? Okay, take notice of the highs and lows and the trend. Remember we said earlier, if you can kind of figure out the trend directional movement, fantastic. And the EMA 200 and the EMA 50 is going to help you with that. The Elliott waves is going to help you with that. The higher highs, higher lows sort of stuff, take notice of that. Where were we? This was in here. Remember we said, no, it wasn't here. Pound AUD. Okay, here. Remember here we said these were higher lows. These wicks to the high were creating higher lows at the 78.6 line. That to me says this market's ready to head south again. So we're looking for entries straight after these hits to the high. This one here is lower than this one. This is lower than this one. This is lower than all of them. These two are lower than this one. I would not suspect that this would go anywhere higher than this. If it does, fantastic. You know why? If this comes and hits somewhere above here and issues us a spike to the high, we're waiting for a 2-bar confirmation, which would be a red candle coming this way, and then we take our entry. And that would go crazy south. If you want it to be safer, let that go crazy south, and then once it bounces back again and then does a fall, that's when you take your entry and you keep going south. And that would probably run for 500, maybe 5 to 800 pips. Might do it over a week or so. So do that. Now, someone did ask me, I'm just going to run through a couple of questions that have come through. If I was to trade this, how often would I trade it? I'd say probably look for entries maybe once a week. And you can look at a number of currency pairs. I like the pound pairs because they move more significantly, because it's all about collecting pips, right? 2 is how many pips would I collect? Depending on the mood I'm in. If I'm trading a 1-hour chart or 15-minute chart, I'm sometimes in and out of the market in 15, 20 pips, 30 pips, 50 pips max. If I'm really reasonably in the right frame of mind and the market on a 4-hourly chart is setting up beautifully for me, and I've caught it at a trend run, a channel going up or down, I'd let it run for a while, and I would utilize this EMA 50 and EMA 200 strategy, the cross, and then price coming back to hit the EMA 50, and then I will take my entry off a stop hunt, followed by a 2-bar confirmation. If I've got, say, a bit of a candlestick pattern that I recognize, fantastic. From that point, I'll just wait for price to come back around, so something along these lines here. Wait for price to come back around to and hit the EMA 50 again, and that would happen in a number of days. I think this was a 2-day trade, right? And this, there you go, 300 pips in the money. If I'm trading these pound pairs, there is correlation between them. So pound NZD, pound AUD pretty much will do exactly the same thing. So if I've analyzed my entries really well there, then I could take the exact same trade on both currency pairs, which would then result in double the amount. So say for instance I take like a 500 pip trade on one of the currency pairs, and that happened over 4 days. You do 2 of them on, you do one on AUD, pound AUD and pound NZD. You're looking about at about 1,000 pip return in 3 or 4 days. Okay, that can make you a crap load of money. Okay, Guys, I hope this has answered some of your questions, or if I've done an amazing job of confusing the hell out of you. If you've got questions in this regard, post them under the comment section, and if I see it, I will respond. But this is by far the easiest strategy that I have ever come across. This is something I've personally traded over many years. And at the same time, what I'd like to say is that this is going to be the start of a series of videos to do with Forex. I know I keep saying that I'm going to create videos about the patterns and the structure itself. There's about a good 6 to 10 patterns that I would work with and recognize, and I'll create individual videos for them. I will get around to them. I just have been lazy. I've just been busy doing my own meditations and stuff like that, so I just don't feel like it. Alright guys, so I will create something along those lines, but in the meantime, all the best. Study this, stare at your charts until you're going half blind. But this does become easier. And for those of you that are trading Nadex or binary off of this as well, you could take longer term binary trades using the same principles. At the same time, you know, for those of you that are doing end of day trades with binary, you could actually do exactly the same thing. Do it off a daily chart, I'd say, where let me jump onto this, whereby what you're doing is, get rid of this. Actually, you know, you can use the Fibonacci for this as well, whereby you wait for actually, you do this off a 4-hourly chart first, so you'd analyze support and resistance, where do you think that's going to bounce off, and then you jump on a daily chart, and if it's on a downtrend, if it's hitting off, say, an EMA 50 or something along those lines, you'd wait for price to be slightly above, and if you know this is going to be a downtrend, you wait for price to be slightly above, and then you take a hit to the south, right? In these cases here, guys, this is beautiful. This is what we're looking for as well, where this is a cross where this behavior, remember, it's very similar to what we did off the 4-hourly charts, where market penetrates past the EMA 50, penetrates past the EMA 200, then pushes back down again. Here's the wave we were looking for. So the wave comes back up, hits it. We're still not doing anything here. So we take a trade off. We wait for these wicks to the high to complete. You could possibly take an entry off here, or if you wanted to take a later entry. And how I would do it is, say, off here. You'd be out of the money briefly here, but we're taking a trade and we want price to come back and hit the EMA 50, remember? So the market does its waves and stuff, and it finally comes back, hits my EMA 50. I don't know how many days out I am, but that is 486 pips. This is right now the 27th of June, so we hit 400 and something pips. I've forgotten already. Okay, so that's a 3-month trade roughly. 490 something. Okay, so that's a 3-month trade. It's way too long for me to be patient. So for those of you guys that would love to do that, fantastic. Go ahead and do that. You can also jump out of your daily trades whenever you're happy. See, look at this. This is 934 pips in the money, and this is roughly a week's worth of trading. Okay, all right, guys. I think that's it from me. But mate, I apologize again for the delay in creating this for you, but I hope I've answered everything that you have in your mind. All the best.